But let's put the spotlight on the value picks in a volatile market like this. What should you be looking at? Well, Vinay, thanks so much for joining us once again. But I want to start off by asking you what you're making of the strength in the markets these days, and what are you watching out for, as we'll soon be discussing earnings in the month of July.
So hi, morning to your viewers, Vinay. Broadly, our sense on market is that we are clearly in an upward trending bull market. You have strong, steep, sharp corrections which play out, which many a times lead to a scenario where people start doubting the bull market hypothesis itself. And that is what is currently playing out. So in the near term, the downward trends and downward pressures could continue. What you're seeing is a relief rally, but the big event which all of us are awaiting is what happens on the Greece front on 30th of June, and that's still 5, 6, 7 days away, plus there is an expiry tomorrow. So the big Greece event, once it's behind us, market will find its direction all over again. Monsoon has been much better than what was anticipated. So that big concern, which was a key overhang, appears to be dissipating. The only other concern which has been bothering the market has been in terms of earnings and the earnings growth. The last 2 quarters numbers have not been very good. And our sense is probably this quarter or next quarter, you will clearly see a bottoming out happen. But will the earnings downgrade happen in this particular quarter? There is a high degree of probability, because the asking rate for both FY16 as well as FY17 at this particular point remains pretty steep and high. So the possibility of downgrade still playing out over next 1 or 2 quarters, but eventually the bottoms will be made and the earning cycle should begin to pick up. So overall, the bull market trend should continue. Maybe there is a pause and consolidation, which is what you are seeing currently.
Vinay, you've got an interesting set of picks for our viewers today, and I'm going to take them through the list of the stocks that you're saying, you're asking your clients to pick up. And of course, among the heavyweights, you have Larsen and Toubro, which is interesting because that's been one of the consistent picks with many of the brokerages we've got over here. But you've got a couple of interesting counters. Indo Count, a stellar performer if you look at the year to date, and of course 1 year performance. Pokarna is the other one, SRF is one, and Bajaj Finance is the last. So 5 picks from Vinay. Vinay, before we start on the picks themselves, I'm going to ask you, what is the criteria by which you've chosen these counters? What are the broad themes that you're working on right now?
So we are very, very bottoms-up stock. A huge degree of time and effort goes into analyzing the quality of the business and what is the strength of the business, what is the moat around the business. Is it possible that this business could come under a lot of stress in the near future and the business may not survive? So there could be technology edges, there could be edges around huge brand values or distribution. So these are the things that we look at in terms of the moat. Otherwise, the size of opportunity and capital efficiency remain our other important criteria when we pick stocks. So if the stock is just having a return on capital of, let's say, 12 or 15%, it's barely breaking even as far as the cost of capital is concerned, those are the ideas that interest us little. But if there is a possibility that this 15% could become 20-25%, or you're already doing 25% kind of a return on capital, then that's another thing that interests us. Because many you'll realize that if companies have good capital efficiency, they will be able to generate a lot of money from within the business to expand, rather than keep on going to banks to borrow and survive and go for growth. So these are some of the things that we look at: moat, opportunity, capital efficiency, and quality of management.
These are the criteria for value picks after all, Vinay, especially at a time when we live with very high leverage companies. But I'm going to start bottoms up, as you said quite rightly. Indo Count, it's a phenomenal stock if you actually look at it. 1 year returns of 675%. Year to date, the stock has given returns of 91%. You still find value on this stock, and you've got a price target of a 759, which is almost 100 rupees from here. So you still expect the stock to rev up, Vinay?
Yes. So let's look at how do you define value. Value could be a very cheap valuation multiple in terms of price, or value could be that a stock is available at fair price, but it's a great business to own and it could compound very well over next 2, 3, 4 years. So some of the picks that we have mentioned today, including Indocount, fall into that particular bracket. Now let's take a deeper look at the business model of Indocount. Indocount basically provides bed sheets, and 85% of its revenues come from exports. So global majors like Walmart, JCPenney, House of Fraser, they are the clients of Indocount. They are significantly present into the relevant segments in US markets where in some of the segments they have almost 40-45% kind of share. The company is getting into the associated segments where only Chinese have significant presence, which is fashion bedding, utility bedding and institutional bedding, which are very, very large segments in US. Now as the company gets into these segments, the size of the opportunity could continue to go up very dramatically. And there is something which is far bigger which is happening in this sector. What's happening is that Chinese, because of appreciation of yuan and higher cotton prices, because of supportive MSP equivalent kind of regime which is there in China, Indian cotton prices and cotton products, cotton manufacturing has become very, very viable. Plus, with what Modi government is doing in terms of Make in India and a huge cross block that has got established over the last 10-15 years under tough scheme on the textile side, you find that India is in a very sweet spot, and Indocount appears to be one of the key beneficiary. So another thing which specializes Indocount is that they are very asset light. So most of the working is outsourced, spinning and so on, which are very capital intensive part of the business. So textile companies are hugely challenged in terms of capital efficiency if they do weaving and spinning and so on. Indocount does 80-85% of its work from outsourced manner, so only finishing is done within the company, which provides company with a huge edge in terms of return on capital. So over next 3 to 4 years, we see that company could continue to grow very well in US markets as it enters into the new segments, as it cracks the institutional market, and the stock could compound very well from here. So on a 1.5 years perspective, you could easily see an uptake of 20 to 30%, but over a longer period of time, this could be a multi-bagger idea.
And above 675% that it is already given, that's interesting. But you know, Vinay, I am going to take our viewers to a comparison of a couple of the stocks in the textile space. The more obvious ones are stocks like Arvind. On the other hand, Alok has run into trouble. The stock is negative returns it has given both year to date and over a year. And then there is of course Vardhaman, which is done well but not as well. You know, how would you compare it with peers, Indocount, and you know, what are your concerns across the textile space as such?
So you'll have to take a deeper look at the textile space. People who are exporting and people who are domestic market focused, one. Second, what is the kind of gross block or capital that they have invested? If a company is significantly into spinning and weaving, it requires a huge amount of gross block. That means your capital commitment requirements are very, very large. At the same time, your ability to get margin out of these segments is low. So what you find is you put in a lot of capital, but the profitability is not so commensurate. So companies which are lesser on the capital intensity side, one. Second, which have clients which are willing to pay you some kind of premium over the other prices, over the competitors, so that you can make better margins. That becomes the second important factor. And third is, what is the company's management capability in terms of expanding the business? So the likes of Indocount and Welspun are better placed in that particular situation vis-a-vis Alok and others.
Fair enough. That's Indocount for you, a very aggressive move up that it has seen over the year, but Vinay believes that this still has room to go up further. The other interesting stock you have is SRF. Once again, that's a stock that has given a fair amount of returns, about 120% over a year's period, that is in the year-to-date period. Again, what do you like about it, and how much leg room do you think SRF has on the upside?
So let's look at the business model of SRF. SRF is into three business segments. One is the tire cord manufacturing, second is the chemical business, and third is in terms of plastic films. Now, if you look at the two businesses which have not been doing too great, one is the tire cord business and the second is the plastic film business. So plastic film business is a 6 to 7 year cycle, 3 to 4 years. The business lose money globally, and 2 to 3 years they make reasonably good returns. Companies set up plants and capacities over the last few years in South Africa and Thailand, and it had not been making money for anybody in this particular segment, including this particular company. So our sense is that this business is turning around. So you will have next 12 to 24 months of good numbers which will come out of this business, and that provides immediate low value trigger. The other part of the business, which is the tire cord business, is considered a kind of a sunset business, because most of the tires manufacturers are shifting to, especially in the car and the other segments. Now you find that though this particular business has not grown, the cross-ply tire demand has not really grown because of radialization, the overall numbers have remained stagnant at about 2,000 crores kind of revenues over the last 3 to 4 years. But the profits, the EBIT number has practically doubled from about 100 crores to about 190 crores. So this says that the nylon tire cord demand remains pretty healthy, especially because of smaller vehicles like Tata Ace and so on using normal tires, the cross-ply tires as compared to radial tires, as well as the profit margins are going up. So in a sunset industry, the demand supply scenario favors this particular segment, and the normal thought in the market that this should be ascribed a very low value is where we differentiate from the market, and our sense is that this business will continue to throw cash flows and will do well. But the part of the business which interests us the most, and that's the reason why we have such a strong recommendation on SRF, is the chemicals business. Now within the chemical stream, the specialty chemical business is what excites us the most. Now let's look at what is the differentiation in SRF as far as the specialty chemical business is concerned. On the chemicals business side, fluorine chemistry is a pretty strong knowledge base that is required, and fluorine chemistry is required to manufacture pharmaceuticals and agrochemicals in a significant manner. Fluorine is a very, very reactive gas, so it's dangerous to handle, and not many companies world over have technical capabilities, one, to handle this chemistry, and second, to take it to the industrial production level. So global majors like BASF, Bayer, Lyndall-Bessel, DuPont, these are the guys who are significantly onto the fluorine chemistry molecule manufacturing, both on the pharmaceutical as well as on the agrochemical side, and then these provide these chemicals to the further pharmaceutical and agrochemical companies. Now SRF over last 7-8 years of efforts has cracked this model well. They have a very large R&D team, and they have been able to convert the molecules that they have generated in the laboratories to the commercial and industrial level. Company undertook a capex of about 600 crores recently. It's already manufacturing 20 of such molecules for these global majors like Bayer, BASF, DuPont, and so on and so forth. Now these are very, very high margin products. Almost 30-35% kind of operating margins can be made in these particular products. Today this part of the business contributes just about 30-odd%. Our sense is that this could improve dramatically. In fact, our sense is by 2020, almost 80% of revenues could come from this business. This business generates a return on capital of almost 30-35%. So increasingly, as the business and the profitability shifts away from more mundane business like tire cord business or the plastic film business, companies' valuation metrics will begin to change. Your profitability will go up, capital efficiency numbers will look very, very, very different, and consequently the PE multiple that the market will give will change dramatically from what it is today.
Okay.
So
that's why you
over
got
next 8 to 10 months or 12 months, this stock could give you 20-25% kind of returns.
Okay, fair enough. Vinay, you've got an aggressive take on that. The chemical side is where Vinay is putting his bets for SRF. We'll head into a short break. We'll come back and also cover the other 3 stocks. One of those stocks has already given a 425% return over the last 1 year. So how much upside is there, and which is the stock? We come back and tell you more about that. Do stay with us. Welcome back. You're watching Value Picks, and we're discussing Value Picks with Vinay Khattar from Edelweiss. Two interesting picks that he's given, Indocount and SRF. Multi-baggers those stocks are, and yet another multi-bagger, it seems, which has already given multi-bag returns, and that is Pokarna, Vinay. Quickly, I mean, that stock is up 420% over the year. Do you still see room on the upside, and what do you like about it so much?
Pokarna is an interesting idea, it's a company which was earlier only into granite and some degree into retail cloth brand. Now, last few years it has entered into another space which is called as quartz tabletop slabs. Now, quartz is a sand-like material which is present in India as well as in China, so you get it out of the ground, and then you convert this quartz into the tabletops or surfaces or tiles, what we commonly call as, and get a finish and quality which is far superior to marble and granite. And because the product is of such fine quality, it is priced almost 2 to 3 times as compared to a high-end granite. Consequently, the market for this product exists only in Western Europe and US and Canada. So in US and Canada, the total tabletop market is almost $100 billion, which is more than 6 lakh crore rupees, out of which quartz was less than 10%. It was just about 8%. It has now expanded by 200 bips just in 1 year. Because of the quality of finish and the uniformity of the product, it is replacing all other segments of tabletops, whether it is laminates, wood, marble, granite, and market is shifting towards this. Now, if you were to see the numbers, company takes the product out of the ground, that is quartz, uses machinery which is made by a company called as Stone, which is a European company. Stone manufactures machinery for this, for manufacturing of quartz slabs, and there are only 10 major global players to which Stone has provided this particular machinery. And Pokarna is one of those companies which are into this space. The largest player is an Israeli company called Caesarstone, and that is a dominant guy in US.
Okay.
If you were to just look at the numbers,
how big is Pokarna in
company
this business?
Manufactures, takes so right now it's very, very small. The total revenues of the companies are just about 400 crore rupees, and eventually you will find that huge amount of growth is going to come from this particular segment as you go forward over next 2 to 3 to 4 years, and that's where the margins and profitability will accrue.
Fair enough. So Pokarna is your pick. The US housing market is not quite what it used to be, Vinay. So given that in the late pickup over there, is that somewhat of a risk for Pokarna, or do you think it's well hedged against this kind of dependence on the US markets?
So one, its complete dependence is not just on US market. He is present in both US as well as Europe. And secondly, he is providing these tabletop material, the quartz slabs, on a B2B basis to larger players who are into the retail segment. And the price differential, he provides this stuff at almost $8 to $10 per square feet. And the retail pricing is anywhere between $130 to $150. So there is a huge difference in margins which the retail guys make, but then there is a distribution cost, there is a cost of fixing and so on and so forth. So in that sense, there is a lot of headroom for this company to grow, both in terms of pricing as well as in terms of volume, given the overall size of the market. If the US housing market was to totally collapse, then of course there could be pressure, but our sense is that even with the existing market, and there is a big replacement demand which is playing out, where people are shifting towards quartz, the near-term headwinds do not appear to be on the horizon. Our sense is that the overall situation will remain pretty comfortable and favorable to Pokarna as far as the housing market is concerned.
We've got 2 more stocks to cover, so I'm going to go quickly through these stocks, Vinay, because of paucity of time. The first is Bajaj Finance, which is interesting because it is in the home loan business as well, and many of the home loan NBFCs have done fairly well, but you have revised downwards your target price. Take us through what you like and why you've done that revision.
So the predominant investment hypothesis on Bajaj Finance has been its exposure to both SME as well as onto the consumer durable financing side. Almost 55% of the book is consumer durable financing and about 40-45% is the SME exposure. The infrastructure side, which company planned to get into 2 or 3 years ago, has not really been an area of aggressive expansion for the company given overall macro environment in India. Now, if you look at the consumer durable business, a lot of people felt that it's a very low moat business. Competition is going to come in, which is going to take away whatever pricing power that the existing players like Bajaj has. But that has not happened. Company makes a return on asset of almost 3.3%, which is one of the highest in the entire NBFC space. And given the capital adequacy ratio and other factors, the return on equity is almost 20%. Company has about 32,000 crore kind of the loan book, which is likely to grow by about 50% over the next 2 years. And overall growth scenario is going to remain very healthy. Plus, it's now focusing on the rural side and getting into new segment like home financing and others, which could again play its role in terms of growing the loan book as well as giving higher profits and higher margins. Our only reason for reducing our target price slightly is because the stock has done pretty well over the last 10 days and it has run up by almost 600 odd rupees over last 10 to 15 days. So maybe there is another 600 to 700 rupees upside which remains, beyond which only the valuation comfort may go away. But otherwise, as far as the business and the quality of management and the moat and capital efficiency and other factors are concerned, this idea remains a good idea.
Okay, fine enough. The last stock is the big one, Larsen & Toubro. We've started this series and at least 3 brokerages have seemed to be very bullish on Larsen & Toubro. What do you like about it, and what's the price target on this one?
So if you've got to play India infrastructure and construction and defense and power, one stock which gives you exposure to each of these sectors in a very significant manner is Larsen. Second big one is what the chairman, Mr. Naik, just mentioned a few days ago, that the focus of the company will shift from Middle East to domestic markets. Now, we know that Middle East has been a problem area. The hydrocarbon sector, which in the Middle East, which Larsen had thought would grow dramatically and aggressively, has shown much more subdued number, and there's been a lot of pain there. Plus, even on the infrastructure side, there's been cost overruns. Net, a low margin business in the Middle East, having a host of problems, will now cease to be the focus area, and company will begin to focus back into India, where the margins are relatively better, plus the growth opportunities are much higher. Another vector which will have short-term impact on the price of Larsen is the listing of its closely held company. So L&T Infotech could be the one which goes off the block within next 6 to 12 months. Company has indicated they're looking at a valuation in upward of $3 billion. This could provide a lot of value unlocking. And over next 12 to 24 months, even the hydrocarbon subsidiary could go out and get listed. So net overall, you'll find that value unlocking proposition plus domestic focus, and there is a clear pickup in the infrastructure, power and construction side in India, and as well as defense. So these could be important vectors which could cause numbers to flow into the company and the valuation as re-rating to happen.
Right, Vinay, we leave it there. Larsen & Toubro, also the fact that it is moving its focus back into India also indicates that it expects the pickup in expenditure and investments to take place, because the Middle East was really a hedge against the deadlock that most of the infrastructure projects were in India. So that's Larsen & Toubro for you, and unlocking value seems to be Vinay's theme over there. Vinay, always great having you on the channel, and thank you so much for joining us with your picks from Edelweiss. 5 very, very interesting counters and stocks that have really given pretty good returns over the last year. We leave it there. Thanks so much for joining us on Value Picks. We'll be back with all the top stories, and we'll be back again tomorrow with another set of Value Picks.